This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, I'm Lee Adler, and this edition of Radio Free Wall Street was recorded on Saturday, June 6, 2015. Well, for the most part, the market has gone according to Hoyle in terms of where it is now and where we expected it to be, all along the track of the cycle projections. Back in October of 2013, for the first time, we saw the long-term projections pointing to the 2,000 to 2,400 range on the S&P, with an 8-year and longer cycle top due between the 2014 to 2016 period, with a time midpoint of mid-2015. And here we are. We went to 2130 or so in the middle of that range, 2,000 to 2,400, right at the time midpoint of the expected time for a high. But of course, there's a lot of play in that. It could come later this year or even in 2016. But so far, we are where we expected to be. As we watch the progression of these long-term projections, they've pointed lately to 2,200 to 2,400. But there's no guarantee that the market will get there, and that's a potential. But what I've seen over many, many years with long-term projections is that they tend to overshoot on the downside as the market becomes increasingly volatile as it sells off, and they tend to undershoot on the upside as the volatility in the market dies as it begins to top out. So it wouldn't be surprising to see the market top out here. What we have to do is watch the indicators on a daily basis and a weekly basis to see where they're pointing and what they're telling us about the condition of the market. But so far, there have been no surprises. So we're going to take a look at a long-term chart of the S&P in a minute and try to get a sense of where we are. As I wrote in the Wall Street Examiner Market Pro update today, that 2090 level is a key level that we have to watch very closely, and I'll show you what that looks like on the chart. On an intermediate term basis, we had projections of 2130, 2135 for quite a while, and then more recently they were pointing as high as 2175.80. We hit the first set of projections, haven't gotten to the second set, and it doesn't look like we will, but again, there's a potential to get there if this current low holds together. If it doesn't, then I think we can write that off. So again, we'll take a look at the charts to see how that looks. Well, this week we had the big jobs report on Friday, and the market was surprised. I don't understand why. The headline number beat the consensus expectation by came in at around 280, plus 280, and they expected around plus 225. Have no idea why they were surprised, because we've been watching the withholding data all along. I've been posting that regularly, and of course that's in real time, and that told us that during the May reference week, the withholding tax collections were growing at a very strong rate, and we expected the growth of jobs to be at least as strong as in April. So there was no reason to be surprised by the strength in this number. In fact, the June numbers, early June, are even stronger than they were in May. So it's pretty clear that parts of the U.S. economy are blowing off. We've raised this issue before, the tale of two economies. You have the vast bulk of the American people who are not enjoying any kind of growth in their income or job prospects. And many of the levels for most people are no better than they were 6 or 7 years ago. But we clearly have a bubble economy in some sectors, and they are just raging away off into the stratosphere. So what happens is, again, when you put those two sets of numbers together, one weak and one very strong, you get this picture of muddling growth. Of course, the jobs number is going to keep the Fed right on track for attempting to normalize its balance sheet, or at least attempting to normalize interest rates a little bit at some point in the next couple months. Whether they do it at the next meeting or the meeting after that is irrelevant. I don't care, but they've been on that path, and the data is certainly going to encourage them. And they've also stated that they're basically ignoring any bad news because a lot of that bad news they see as transitory. I see it as a problem with how the data is reported. The seasonally adjusted data is often misleading, particularly when it's reported on a month-to-month basis and then annualized. They take the error and annualize it. So the numbers have been misleading in many cases, but the jobs data here is not. We look at the actual data, the not seasonally adjusted data. We put it on a chart, and we use some trend indicators to show us exactly where that's going. And I have a picture of that we'll look at in a minute or two. And also the withholding data, again, reaffirms that there is a lot of strength in terms of the numbers of people that are getting jobs, and in terms of maybe people at the high end seeing their wages go up, and that's inflating the totals. But there are cracks beginning to show up in the facade, and particularly the bond market. It's hard to understand with Treasury supply so light, and with the ECB buying and the Bank of Japan buying. Why is the Treasury market and bond markets around the world, why are they acting so badly? It suggests that something's going on beneath the surface, that something being selling, and a change in sentiment. The big boys are tiptoeing out the back door, and that's creating an undertow of selling. Get that same feeling about stock prices here, that they're beginning to walk it down just a little bit. Are they going to break 2090 and start a little panic? Well, if they do, it'll probably be another buy the dip kind of thing where they run it up again. But the signs are beginning to build that we are in the distribution top phase. So again, we'll take a look at these charts on the bond market, on the S&P, and let's go and take a look right now.